Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to foreign currency cash management. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 713 Foreign Currency Cash Management tab in the Practice Problems section. Closing this back out, we're going to have our information up top. We'll be working through the practice problem with that information. Now note, as we think about this foreign currency cash management, we're touching on the concepts of foreign currency cash management. We do have a course in advanced financial accounting that gets into a lot more detail about the recording of foreign currency. But we want to get into just basically the concept of it here and the general idea of how we would value the foreign currency, because when people first look at the foreign currency, it can be quite intimidating to look at, and we often think about it as being kind of separate than other types of investments or assets that we might put on the books. And if we think about it from a certain perspective, it's a lot more similar than we would think to recording other types of investments and management and managing them basically in a similar way. So as we think about the foreign currency, if we have our books in US dollars, and that's how we record, that's the measuring tool that we use. When we think of other currencies, the thing that's confusing is we're basically thinking about something that's another measuring tool, right? If we think about, in this case, the Japanese yen, we're going to say, well, then the yen is another measuring tool. The books, if we were to keep our books in yen, we would be using that as the measuring tool of our books. So we have to first just realize, of course, that we're going to be measuring in terms of a standard unit, which is going to be dollars. And then when we think about yens, then another currency, even though we're holding on to another currency, to us it's just something else that we're going to be measuring in dollars. So for example, if we just had yen that we're holding on to, another foreign currency in a bank account, then we could just say, well, this is how many units of yen that we have, just like we would say how many units of stocks we might have, and then we would simply value the yen in terms of the measuring tool that we're measuring our books in, that being the US dollar. So in that sense, we can think about basically foreign currency in the same way that we think about any other type of investment. We're holding on to this many units of something, whether it be stocks, bonds, or foreign currency, and we're simply going to measure that in terms of dollars. How would we know how we're going to measure it in terms of dollars? Well, just like stocks and bonds that are publicly traded, the currency is something that's going to be traded all the time. It's being exchanged as well. So the currency is basically another market. So we, just like we would do with stocks and bonds, we can look at the market and say, where's the current yen stand as relation to the dollar, so that we can basically value our investment. So that's going to be the general idea. Now, it's a little bit more complex. If we have the yen, we're going to have the yen and we invest it in something. So let's say we have the foreign currency that we're investing into a savings account or some kind of investment, let's say a savings account that we're going to get a return on. We're going to get interest on that. So if we're going to put our foreign currency into a savings account, then we're going to get two things are going to be happening. One, we're going to get interest on it. We're going to get a return, and say the interest. The interest will be paid to us in yen, the foreign currency, in this case yen, that are going to be paid to us. And so we're going to have to record that increase in the value that we have, the return. And then we're also going to have this varying concept happening between the number of units of foreign currency we have fluctuating with regards to the US dollar. Now, there's a couple different ways that we can kind of record this on our books, but your basic perspective you want to be grounded in is that I need to record it on our books in US dollars, right? Because that's the measuring tool we use. So let's take a look at this example. We're going to say the foreign currency, let's say we're holding 280,000 yen, and that's how much yen we have. So we actually have the physical, or not, digital, most likely, foreign currency of the 280,000, we could think of just units of yen. And we're going to say that the equivalent is $53,000. Now, that exchange rate, this isn't a current exchange rate or anything like this. It's just an example problem, and we could get that from the market, right? We would get the market exchange rate. And for more practice problems on that, take a look at the advanced financial accounting course. But let's just make this assumption. We've got the yen, 280,000. The current value of it, or the value at the starting point of our practice problem, is $53,000. That's going to be the US dollar equivalent. Therefore, we would record this on our books at the 53,000. That would be valuing of the yen, just like we would for stocks. We would be saying, we don't record how many units of stock we have in, say, a company like Apple or something. We record the dollar value of it. Same thing we're going to do with the yen here. Then we're going to say that there's an interest on the funds that are earned. So the 280,000 yen that we have is going to earn 9% return. Now the return that we would get paid in, of course, the yen. But if we know the rate, the 9% return rate, we can apply that to the dollar value. So there's a couple different ways that we can value this in the future. But then we have the foreign currency decreased relative to the US dollar of the 6%. So two things are happening here. We had our original investment that's going to be in an investment account. We're going to get a return on it. We're going to say interest. Interest, we received 9%. So we got to record the 9%. And we know that the value of the yen has decreased relative to the value of the dollar by the 6%. So a couple ways we can do this. Let's take a look at it. We're going to say that we're going to have the US dollar equivalent starting at the 53,000. So notice we're going to say, put it on our books, $53,000 worth of yen that we had. We're going to say that there's a 9% return on it. So we've got interest of 9%. The 9% interest would be paid in yen, but it's a 9% increase. So if I know the dollar equivalent, and I say that there's a 9% increase, then we could say the 53,000 times the 9%. So 53,000 times 0.09 gives us 4,770. And if we add that to the 53,000, we get the 57,770. Obviously, we can do that two ways. We can say the 53,000 times 0.09 plus the 53,000 gives us the 57,770, or the 53,000 times the 1.09, 100% plus the 9%, giving us the 57,770. So then we have have to also be considering then the decrease in the value of the currency. So this was where we would stand if this was an investment in US dollars and we got interest at 9%. But now we're at the 57,770 in yen. It's a later point in time, and every day the value of the yen compared to the US dollar, just like stocks, will change. So we're going to say it decreased by 6%. Well, if that's the case, 57,770 times the 6% would give us the 3,466. 3,466. 57,770 minus the 3,466 gives us the 54,304. Once again, we can get there a couple different ways. We can take the 57,770 times the 0.06. That's going to give us this amount. It's rounded here. And then if I subtract out the 57,770, we're going to get down to the 54,304 about. Or we can say if we take 100%, or 1 minus 0.06, that means we're still leaving 94%. And then we can just take that 94% times the 57,770. That's going to give us our 54,304. So bottom line on the foreign investments, when we're holding on to foreign currency, we could have two things that are going to be taking place, but just always keep your perspective on the fact that we're got to record the foreign currency still in US dollars, basically. And once you take that perspective, it becomes very similar to investing in anything else, such as stocks, something that's on a market, something that you can see day to day changing. You know what the market rate is because it's trading on the market, and you can use then the exchange rates to figure that out. Two things will typically happen. You might get interest on the holdings that you have from the bank that you'll have to record, and then you'll have the difference or variance in terms of the exchange rates from the foreign currency to the US dollars. Let's take another example and do it one more time. So we're going to take the Mexican peso here, same kind of thing, 360,000 foreign currency US dollars equivalent 230,000. This isn't the exchange rate, the current exchange rate or anything, it's just an example problem. So if you want more of them, you can take a look at the advanced financial accounting course and you can take a look at it more. But the 360,000 is in pesos, and we're going to say then the equivalent 230, and that will be our starting point. Then we're going to say that there's interest earned at the 11%, and then the foreign currency decreases relative to the US dollar 31%. And so it's a large decrease here. And note, obviously, when you're investing in foreign currency, And again, this doesn't have any relation to the actual currency relationships here, but just to show the fact that there's a substantial risk, obviously, when you put money into the foreign currency, if the foreign currency was to fluctuate. So when you're thinking about the foreign currency, the question, of course, is how strong will the foreign currency be, and how likely is it for the foreign currency to be fluctuating? And then you can think about how you're going to be playing the foreign currency with regards to that fluctuation, as you would with any other type of investment. So we're going to say then the value of the holding in US dollars is what we would record it as. So our withholding, we'd say we have 360,000 basically units. It's foreign currency, but it's just units that we have that we're going to record those in terms of our measuring tool, US dollars, at the 230,000. We're going to say there's an 11% return, meaning interest on the 230,000 currency that we have in foreign currency is going to be paid to us. It's going to be paid in foreign currency, but considering we know the percent increase should be the same. So if we recorded 230,000 in US dollars, the 11% increase would bring us to the 25,300. Would bring us another 25,300, the 230,000 times the 11%. And then if we add the 230,000 plus the 25,300, we get to the 255,300. So in other words, we could take the 230,000 times the 0.11, that gives us the 25,300 plus the 230,000, or we can take then the 1 plus the 0.11, which is 111%, times the 230, and that'll give us the 255,300 a little bit faster. And then we have to consider the fact that the rate of decrease in the value of the foreign currency, it went down with relation to the US dollar 31%. So then that means it went down by 79,143, and that will the 255,300 minus the 79,143 would give us then a value at the 176,157. So let's just do that a couple ways. We can take the 255,300 times the decrease, 0.31, gives us the 79,143 minus the 255,300, and that gives us the 176,157. Or we can take 100% minus the 0.31, 31%, leaves us with the 69% times the 255,300, and that'll give us to that 176,557 a little bit more quickly. So again, bottom line here is that there's those two factors that we could have with regards to the value, but just remember that when you value the foreign currency, you're going to just put it on the books. We're recording it in terms of kind of like any other investment, because we're measuring it in US dollars. Also note that you could do this another way, right? We could basically calculate the 11% increase in the foreign currency here, so 360,000 pesos plus the 11% increase, and then use the exchange rate again, whatever the current exchange rate is, to figure out what the current US dollar equivalent would be, and then we can back into our adjustment in that way as well, right? So in this way, we looked at the percentage increases to figure our US dollar equivalent. We could then figure this thing out in foreign currency and then go and look at the current exchange rate to figure out what the US dollar equivalent would be from the point we stand in terms of foreign currency. So again, for more example problems on that, we go into it in depth in advanced financial accounting.